Welcome to the deep dive. You sent us some really fascinating source material this time. We're going to unpack this pretty unique, maybe even counterintuitive view on real estate investing. It's this bold idea, really, that every real estate deal is actually a flip. Doesn't matter if you're wholesaling it, finding a property and selling the contract, or flipping it quick for profit, or even if you're planning to hold it long term for that passive income stream. So our mission today: extract the key insights from this podcast interview we looked at. It features a very successful investor. We want to understand how this mindset works, how you navigate maybe tougher markets with it, and crucially, what practical steps you could actually take to apply this yourself.
Exactly. Think of this as maybe a shortcut, a way to get informed fast on an approach that, yeah, it might challenge some common wisdom, but it's clearly, generated some pretty incredible results for the investor in our source material. We're going to break down those fundamental principles, the ones that let them build while a multi-million-dollar portfolio, apparently, regardless of market conditions.
Okay, so this core idea, every deal is a flip, that really jumped out at me from the source. It just feels, I don't know, counterintuitive maybe. How can they define flip so broadly,
Yeah.
covering quick sales and long-term holds?
It does sound like a bit of a stretch at first, I agree. But when you hear their story, it kind of clicks. Our source really highlights that this investor sees it all as the same fundamental game. The pattern is always buy at a discount, add value somehow, and then monetize that value. And, well, the proof is in the pudding, as they say. They apparently started back in 2013, just one 4-unit property in Atlanta. And within, 18 months, became a millionaire. So the source emphasizes this wasn't about, catching a market wave. It was sticking to these core fundamentals, unchanging fundamentals.
Right, so it's not about timing the market, high rates, low rates, whatever. It's about being smarter in how you buy. That sounds good, but a lot of investors, they get kind of paralyzed by market news, right? What's the mental shift here? How do they actually ignore the headlines and just stick to their plan?
Well, what's really interesting is their laser focus. They only look at distressed or underperforming properties. The investor says it point blank in the source. If you can't add value, it's just not a deal. End of story. They give a great example, too, a property listed at $195,000. They bought it for $151,000. And it wasn't some secret off-market thing. It was knowing their numbers cold, having the confidence to offer low because they saw the potential value they could create.
Okay, offering that low, that's pretty bold. That must mean they can size up deals incredibly fast. I can almost picture the, traditional agents maybe wincing a bit at that approach. What's the secret then? How do they crunch the numbers so quickly?
Yeah, they have a formula, and it's surprisingly straightforward, which allows for that speed. It's called the maximum allowable offer, or MAO. You start with the ARV, the after repair value, what it'll be worth fixed up. Then you subtract everything: commissions, closing costs, holding costs, the actual renovation budget, and importantly, your desired profit, what's left. That's your maximum offer. They claim, and this is pretty amazing, they can do this in about 5 minutes, sight unseen, though crucially, always with contingencies built in. Protect yourself, right? It's all about taking the emotion out and just focusing on the math, the value-add math.
That quick assessment, yeah, that seems vital, especially thinking about, the current market climate. Lots of listeners might be worried about high interest rates, maybe rising taxes, particularly looking towards 2025, like the source mentioned. So how does this investor handle cash flow and profitability when things aren't, say, booming in any market?
That's a really important point. And their approach is quite strategic. Okay, so high interest rates, they lean on DSCR loans, debt service coverage ratio loans. What's key about those is they look at the property's income potential, not really your personal credit score so much. So if the property itself cash flows enough to cover the loan payment, that's the main thing. This lets them keep scaling without, maxing out the personal borrowing capacity. And they also just double down on that core strategy we talked about. Buy distressed, fix it up, and then aim to significantly increase the rent, like double it if possible. The source had a specific example, a property going from $800 a month in rent to $1,600 a month after they finish the renovations. That's a huge jump in cash flow right there. That's how they create profit, even when the market's challenging. They manufacture the value.
That's really powerful, creating your own upside. Okay, speaking of strategy, the investor mentioned putting 25% down, which is interesting, right? Because you hear so much about no money down deals in real estate. Why wouldn't they just do that? What's the hidden risk maybe they're avoiding? And how does this tie into that infinite returns idea they mentioned?
Yeah, it's a fair question. No money down sounds like the dream, doesn't it? But they actually view it as pretty risky, too much leverage potentially. So their preferred path is put down that 25%, skin in the game, do the renovations, get it stabilized, rent it out. And then this is the crucial part, refinance the property, usually within about 18 months, to pull their initial capital, their down payment and renovation money back out. You might know this as the BRRR method,
Mhm.
basically. Buy, rehab, rent, refinance, repeat. This is like a focused version of that. And that's what they call the path to infinite returns and passive income for life. Because once you get your initial cash back out, your investment in that specific deal is effectively zero, but you still own the asset and it's still generating income.
Infinite returns, though, that's a good claim. You mentioned BRRRR, which many know.
Yeah.
What's the specific nuance here in this investor's way of doing the refinance? Is it just the speed or the amount of value they add that really unlocks that consistently?
I think it's really the combination of all those factors working together intensely. It's that relentless focus first on buying at a really deep discount. That MAO calculation is key. Then it's the efficiency, getting significant value added quickly and cost effectively through the renovation. And then it's the rapid refinance, pulling that capital out fast so they can recycle it into the next deal. They're not letting their money sit idle for years. Because they bought low and added substantial value, the new appraisal for the refinance is often much higher. That makes pulling their initial cash out much easier and more effective.
Okay, that really reframes it. That's a true game changer perspective on capital efficiency. So for listeners who are thinking, okay, I get the mindset, I want to start applying this, what are the real actionable takeaways, the gold nuggets, as you might say, from the source? What's the specific advice tied to how this investor found success?
The tips are super direct, actually, and maybe unique in how simple they sound compared to how complex people make investing seem sometimes. First, stop overthinking it. Seriously. Analysis paralysis, it's a killer. This investor is all about quick action based on solid numbers. Second, and this might surprise people, make offers on MLS listings. You know Zillow, Redfin? They said 80% of their deals came from these common platforms, not some secret network. The insight there, I think, is they're just willing to make way more offers than most people. They see value others miss because they know their numbers inside and out. Discipline. Third, you absolutely have to know your ARV, your after repair value, and your reno costs. Like, know them cold, that MAO formula, that's your foundation. And finally, don't be afraid to offer low. Don't worry about insulting someone. They quoted, you miss 100% of the shots you don't take. Their success seems built on volume, discipline, and knowing the math, not on finding some magical, elusive deal.
That is such practical advice.
Yeah.
It really brings it down to earth. Start with one deal. Do it right based on these principles. Then scale up. I mean, this investor, the source says, went from that one first deal to $1 million in cash flowing assets relatively quickly. It's pretty inspiring, actually. Shows what happens when you just focus relentlessly on those core fundamentals. So yeah, wrapping this up, adopting this every deal is a flip mindset, it really seems like it could be transformative, a way to potentially unlock financial freedom through real estate, kind of irrespective of the daily market noise. It's about seeing that value-add opportunity everywhere.
Absolutely. Understanding these core ideas, buy, discount, add value diligently, monetize strategically, it can fundamentally shift how you approach investing. Makes you more resilient, more agile, and ultimately probably more profitable over the long run.
All right, so here's a final thought to leave you with, something to maybe chew on. Think about this. What other areas of your financial life, or even just your life in general, could benefit from this buy low, add value, monetize frame? How could applying this flip mindset, maybe metaphorically, beyond just real estate, how did that unlock unexpected opportunities? In your investments, sure, but maybe your career, your personal projects, something to think about.